There is a strange probability hidden inside the stock market. You can be right about the economy, right about a company's long-term potential, right about the direction of innovation, and still miss some of the market's most important gains simply because you were not invested when they happened. That is the part many discussions about market returns overlook. The real danger is not only losing money. It is also being absent during the relatively small number of powerful advances that can disproportionately influence a long-term outcome. So what does it actually mean to say that investors can miss the biggest market gains? It does not mean that every major rise is predictable, or that staying invested guarantees success. It means something more subtle. Market returns are not usually distributed evenly across every trading day. Some periods contribute far more to the overall journey than ordinary periods, while those powerful moves often arrive precisely when confidence is weakest. That creates the central contradiction. People often imagine that the safest moment to participate is when the market already feels safe. But by the time confidence has returned, a significant portion of a recovery may already have occurred. The market does not wait for human certainty. Prices respond to changing expectations, and expectations can change faster than personal emotions. This is where probability becomes more useful than prediction. You do not need to know which exact day will produce a major gain to understand the structural problem. You only need to recognize that the future contains a distribution of outcomes, many ordinary days, some difficult days, and a smaller number of unusually powerful moves. Missing one of those moves can change the mathematics of the entire period being measured. Imagine someone examining a long investment history and removing only a handful of its strongest market days. The resulting return can look dramatically different. That thought experiment is not a prediction of what will happen next, it is a way of understanding concentration. When a relatively small number of observations have an outsized influence on the final result, timing becomes an enormous source of uncertainty. And this is where psychology quietly enters the equation. After a market falls, fear does not merely describe the situation, it changes how people interpret information. Bad news feels more credible. Recovery feels temporary. Cash feels psychologically safer. Waiting feels intelligent. Then the market begins recovering, but the investor waits for confirmation. The confirmation arrives after prices have already moved. Waiting produces more confidence, but that confidence may arrive later than the opportunity it was supposed to identify. The irony is powerful. The desire to avoid uncertainty can create another form of uncertainty, the uncertainty of not knowing when to return. History repeatedly shows why this matters. Major market recoveries can begin while headlines remain uncomfortable, economic data remain mixed, and public confidence remains fragile. Markets are forward-looking mechanisms, not emotional mirrors of today's news. They attempt to price expectations about tomorrow, while individuals often react to what happened yesterday. That difference between market time and human time is one of the deepest ideas in investing. Human beings naturally prefer narratives with clear beginnings and endings. The decline is over, the recovery has begun, now it is safe. Markets rarely provide that clarity in real time. The turning point becomes obvious mainly after it has passed. Before it happens, it looks like another uncertain moment. This is why the phrase, missing the biggest gains, should not be interpreted as an argument for reckless participation. It is an argument for understanding trade-offs. Remaining exposed to markets carries risk. Reducing exposure can also carry risk. Holding cash can protect purchasing power from market declines in some circumstances, but inflation and opportunity cost exist. Being investor can participate in recoveries, but market values can fall substantially. There is no position that eliminates uncertainty. The deeper question, then, is not simply, should someone stay invested? That would turn a complex subject into a simplistic instruction. The more useful question is, how much uncertainty are we willing to accept in exchange for remaining exposed to an uncertain future? That question connects markets to ordinary life. A household does not usually know exactly when income will rise, when an emergency will occur, or when a major opportunity will appear. Yet it prepares for possibilities rather than demanding certainty first. Investing contains a similar structural problem. The future cannot be scheduled around the moments that matter most. There is another hidden mechanism here. Measurement itself can distort perception. Investors frequently compare outcomes over a fixed period and then assume the result represents a smooth journey. It rarely does. A long-term return can conceal years of volatility, sharp recoveries, prolonged stagnation, and brief periods of extraordinary movement. The final number is an endpoint. It does not reveal the emotional path required to experience it. And that is why behavior can matter as much as mathematics. A theoretically sound investment process can fail in practice if fear, overconfidence, impatience, or the constant search for certainty causes someone to repeatedly change course. The challenge is not merely identifying what markets can do. It is understanding what we might do when markets actually do it. There is a lesson here that reaches beyond finance. Lord Hanuman represents a very different relationship with uncertainty, discipline without obsession over immediate recognition, courage without arrogance, and action without attachment to controlling the final outcome. Applied carefully to investing, that does not mean taking more risk. It means recognizing the difference between disciplined participation and emotional reaction. The market will always contain days we could not predict, gains we did not capture, and declines we were grateful to avoid. No investor can own every opportunity. The objective is not to eliminate regret by predicting every turning point. That is impossible. The deeper objective is to understand the probability structure of markets well enough to recognize that the most important moments may arrive when certainty is least available. Because the biggest market gains are rarely announced in advance. They are recognized afterward. And perhaps that is the real lesson behind missing them. The greatest uncertainty is not knowing which day will matter most. It is believing that we will somehow be given enough certainty beforehand to identify it. Markets do not promise that certainty. They offer possibility. And between possibility and certainty lies the entire discipline of investing.